know what that does to the risk behavior of the market? That's an animal spirits igniter.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome to the Phil Bach Podcast. This week's guest is Tony Greer. Tony is the editor of the Morning Navigator Newsletter. Tony's a macro analyst from Atlantic Beach. So shout out to my listeners in Pebble Cove and from New York's Long Beach and the Five Towns. TG Macro, Tony's firm, provides fundamental, technical, and behavioral analysis to institutional clients. Tony's featured regularly on Seeking Alpha and Real Vision. And as mentioned, the editor of the Morning Navigator Newsletter, which is fantastic. Tony, thank you for coming on.
Phil, thanks for having me, man. It's great to be here.
All right. So Tony's traded FX, commodities, equities. He's focused on global macro. We're going to do a deep dive into oil and everything that's been going on in the oil markets of late, because it's something we may never see again, or at least we may never see again until the next month contract expires. Yeah, so I don't know. Yeah. We're not out of the woods yet. But before we jump into that, Tony, I thought it'd be helpful if you gave us a quick run through of your background and how you got to today.
Sure, Phil. I'll keep it as brief as I can because it's kind of a long, agonizing story. I really divide my career up in two halves before I started my own business. In the first half, I was an FX and currency and commodity trader, primarily at Union Bank of Switzerland and at Goldman Sachs. That's where I learned everything that I know about commodity trading, to be totally honest. From there, I was at Goldman Sachs for 6 years. I was operating largely in the commodity area, and outside the door was the tech boom going on, from 95 through 2000, et cetera. I was investing heavily in tech stocks, and after Goldman Sachs went public, I decided to try to take it on the road and go on my own in 2000, 2001, and started my own trading company and began trading equities. What was really, that was a really interesting and eye-opening experience to rip the Band-Aid off and go try something on my own. And it was really interesting to see what it entailed to set up your own operation. And the operation was not successful over time. It was not profitable enough over a couple of years. So I wound up segueing into equity sales at the Wall Street table, basically utilizing my commodity experience as my differentiated edge as an equity salesman. And then that second half of my career, I really paid way too much pickup basketball, jumping around from one shop to another. I was pretty unhappy after the last several moves, and I realized that the only constant in my work over the entire career body of work was that I had written about markets pretty much since the day I joined Goldman Sachs. And so I kind of turned that writing into an analysis of markets and turned it into a more structured newsletter, writing about markets every day. And I had the support of a lot of clients of mine that said, "You're ready to take this on the road and go out on your own." So, I left that pickup basketball broker-dealer merry-go-round and finally started TG Macro in August of 2016. And it's one of the greatest moves I've made in my life. I'm very happy with it.
And are you trading as well? Are you trading your own account? Are you trading for clients? Or are you just focused on the newsletter and the analysis?
Yes, I do. I trade my own account. I only trade my own account. I do have a plan to eventually trade client money in a sort of wealth preservation form, but that's my longer term plan for TG Macro in the 5-year horizon. Right now, I'm concentrating on my two core businesses, which are my publishing business and my consultation business. So I'm really trying to get the publishing business roaring right now, and it's gone fairly well in the last couple of months.
All right, let's jump into the market. So I think a lot of people don't remember, but when the shit really started to hit the fan, when everything started, when people first started to realize that, okay, the coronavirus fallout was going to be a lot worse than people had thought throughout January and February, and all of a sudden, the NBA was closed and then all the schools started to close. It happened very fast. And right in the midst of it, there was a whole collapse of OPEC, which led to the collapse of the oil price. And it really coincided. And I think the two events together really helped exacerbate each other. Let's kind of go back to the beginning of how everything started and kind of set the table with what would come, I guess, starting with the collapse of OPEC.
Yeah, we could start with that story. The collapse of OPEC was definitely relevant, as they would need coordinated action to cut output in the first place. So that was sort of a destabilizing event before we had a destabilizing event. Well, on top of that, we ran into the perfect storm of the sort of, we had the demand destruction from the coronavirus lockdown. We had Saudi Arabia and Russia at the same time decided that they were going to put the shale business out of business, and they started dumping production into that. And we had the storage situation, which was getting largely full at Cushing, with spreads starting to trade into contango. You already had the physical guys floating storage out on the water to start taking advantage of that contango, and the front month getting really, really heavy. The reason the front month gets heavy is because the commodity indexers and USO happen to occupy those front months of the crude oil curve. And that's where all the length was going into this shutdown.
Yeah, let's unpack that and kind of take that back a little bit. So when we talk about trading oil, we don't talk about trading what's called spot oil or what the price of oil is at the moment. You're talking about oil futures, because storing oil carries a tremendous cost, a tremendous fixed cost. And for the most part, the liquidity in the oil market is in the futures contracts. And I guess, if you could just take a step back, Tony, and just help us define the futures curve, what that means, contango, and how storage costs play into that.
Yeah, absolutely. So when there is an abundance of oil, I think is the first place to start. Okay. And there is abundance of oil. That usually means that the front months are at a discount to the back months, right? Because there's so much physical oil around that people are in no rush to buy their oil. So they buy it last minute. There's plenty of storage. There's usually a contango curve in that situation, which is where the front months trade at a discount to the back months. Right. So that's a front month contango. And then when we have the flip side situation, when there is very little physical oil around in storage, meaning at Cushing, Oklahoma, where the commodities exchanges are priced here in the US, at various other delivery points, then you have the front month of the futures contracts trading at a premium to the back months. So if you can kind of picture what that curve looks like as an opposite of the other curve, that situation occurs when people are buying their oil last minute, but there is a shortage of it. So the problem is that the immediate oil price is rising while the back months are not rallying. So that's a little bit of a basic example between the difference between backwardation and contango. Going into this situation, we had a sort of normal contango, which was just, 25 cents, 50 cents per month, where the front month would be cheaper than the back months. And then, like you said, I don't want to get too far ahead of it now because I like the pace that you're going at. It's very explanatory. And then we ran into the situation, if you're ready to go there. But the most important thing I think to realize is that we've got the unique situation in crude oil futures are that crude oil is constantly burned every day, right? In the form of gasoline, in the form of diesel fuel, in the form of jet fuel. The byproducts of that go into making plastics and all kinds of other household items, et cetera, et cetera. So while the economy is moving along, all of this gasoline, all of this crude oil is getting burned up, refined, and processed into its final package. And then, like you said, I don't want to go too fast, but then we ran into the lockdown and everything changed.
Right. So demand collapsed. There's more oil being produced than there is demand. But at the same time, the storage facilities had already been full, and there's nowhere to store the oil. Now, the storage facilities, they weren't full just based on the normal drop in demand, right? I mean, what was the story there?
No, correct. I think the proper way to look at it is that the Cushing facilities where oil is stored never really get filled to 100% capacity. They have to leave a lot of capacity empty where they don't top off the barrels, meaning those gigantic tanks, so that they can transfer oil through them to other areas, right? So the storage facilities never get 100% full, but when they get to 75, 80%, 85% full, that's capacity for them, right? So that will happen, obviously, when we're not burning gasoline and we're not refining oil. It literally will just get stacked up and you need a place to put it, especially since we're still pulling it out of the ground, despite the fact that we aren't burning as much during this lockdown. In fact, we're not burning any, relatively speaking. So now we start to get into that situation where the tanks at Cushing get to full capacity. We still have oil majors pumping oil, trying to get it to their refineries to get cracked into gasoline and the products, et cetera. But there's no place to go with it. So now you have a situation where the pipelines get full. You can no longer transmit oil. The tanks are full and there's no place else to put it. And then you have the only outlet at that point is the spill has to transfer into the price. And then we had the situation where the May contract went negative because when you are on the exchange and you are in the position to take delivery of physical oil, if you have no place to put that oil, you would rather pay somebody else to take it off your hands, which is the situation that we had with negative oil contract in May.
Yeah, that was really something else. And, I speculated at the time. It turned out to be, in fact, what happened, that there were traders who were buying oil futures that right before expiration. There's an article in Bloomberg about a trader on Interactive Brokers that was buying at $3.50, which is over the long term probably a reasonable bet. It's historically low. Then he doubles down at 50 cents and then he starts trading at a penny. Now, I think it was something like $10,000 that he put in at a penny, which is 1 million contracts. And you're thinking, wow, man, if this thing bounces up just to a nickel, I've turned my $10,000 into 50 grand. If I can get back to my 330 entry price, I've made 3.3 million bucks on a $10,000 investment. Obviously assuming that at zero is the price floor. So if I lose my 10 grand, I lose my 10 grand. It's risk capital. All of a sudden he's getting margin called down at negative $37. I shouldn't laugh. I mean, he owes Interactive Brokers millions and millions of dollars. And I think there are more people like that.
You're almost allowed to laugh because what that trader did developed a pretty serious really exposed a pretty serious misunderstanding about the market, right? I mean, not knowing certainly. I think the negative price caught people by surprise, right? People didn't know that was a possible mechanism, that prices could go negative only because the merchants would rather pay somebody else to take it because they have no place to put it. So I think the negative dynamic caught people by surprise. And I guess that's just a function of not understanding how Cushing works, because when it's full, right? And if you don't have the physical ability, you should know going into the agreement to own a futures contract what that entails, and especially what that entails going into the delivery of it, which we were doing as we were coming into the last couple of trading days of May there, as it went into negative terms. I mean, you got to understand what that means. You know what I mean? That if you're long those contracts over expiry, the mercantile exchange is going to be ringing your phone and ask you, where do you want to put 10,000 barrels of oil?
Yeah. Well, one of the pieces to the puzzle that really caught my attention, and I thought it was very underreported and under talked about, was the fact that Saudi had been sending oil into Cushing, into those storage facilities, well in advance of the collapse of the price. What do we know about that? I mean, was that intentional? Was that a strategy? Was that, what was the purpose of them doing so, and what were the effects?
Yeah, that's Machiavellian, right? I mean, it was absolutely done on purpose. It was absolutely done with nefarious intentions. I mean, I feel like for years now, Mohammed bin Salman has been sort of, at first he needed the U.S. E&P and shale players to get Saudi Aramco off the tape. On the tape, and he sort of went around several years ago with that political tour of his where he, shook everyone's hand and said that he was going to manufacture the price of oil back out of these doldrums, and he was going to launch the Saudi Aramco IPO and bring prosperity back to the kingdom again. And no sooner did he get the IPO off the ground did we run into this situation. So I think that he was being opportunistic and saying, well, if this situation I can't let fail, and what does this situation allow me to do? Try to put the U.S. shale out of business and lose one competitor. And so that's the direction, probably in a backdoor agreement with Russia, where they posted it as they were sort of having a separate argument about it. But I would imagine that Russia and the Kingdom of Saudi Arabia were probably colluding to both send as much oil over here as they can to finally drown the shale in oil. So yeah, that was that was an intense moment. There's still oil that Mohammed bin Salman sent over here on its way. So that's going to make it eventually to the tanks, but I think it's going to make it to the tanks after we turn the spigot back on and open up the economy. So hopefully we'll be moving some of this oil out of Cushing and into refineries where they can burn it for gasoline. So still remains to be seen, but it's an interesting setup.
If industrial production starts to ramp up again, and if we do turn on that spigot and the economy starts to come back, I mean, are we out of the danger zone here with oil? I mean, would you go long oil from here?
Yes, I think that we've got a generational opportunity to be long oil. You made a really interesting, a very subtle comment before, like, I don't know if we'll ever see that again in reference to the May contract going negative. And I'm in the camp that we'll never see it again. I think this is a generational opportunity to buy energy assets. One of the other dynamics in the perfect storm just before COVID-19 broke out was this big ESG push, right? Environmental, social, and governance criteria of companies, right? Larry Fink basically came out and said BlackRock is not likely to be a large holder of fossil fuels going forward, right? It was a big part of this, of this green movement here in the United States. And so sort of that was another weight that the E&P stocks had on them. Then we had this episode with the coronavirus outbreak. And I think on the other side of it, it's going to be a lot harder to sort of implement the ESG guidelines for everybody because we've got a bigger crisis on our hands in this health crisis. So with that sort of ESG veil removed or sort of at least knocked to the back burner for now, I'm really looking to buy energy companies because I firmly believe that shutting off the global industrialized economy was a once in a lifetime anomaly. I believe that watching the mercantile exchange react to it very much behind the eight ball in terms of saying, now that May has gone negative, we're going to put negative prices on the board for the next several contracts, and we're going to put negative option pricing. And, usually as soon as an exchange gets set up for something as absurd as negative energy prices, that's when the world comes out and tells you that it really is that absurd. And what's really important about the dynamic now is that rig count is imploding. Right. So they are capping off rigs left and right. You're starting to see major E&P companies shut in production. Right. And when you shut in production, you don't just stop pulling oil out of a well, you shut the well down. Right. And when you shut in a well, you actually damage its potential to yield good oil in the future. So we're doing all of these things now to react to this shutdown in activity. And all that's going to happen eventually, and I don't think it's going to happen. I know it's going to happen. We're eventually going to run into that front month shortage where the tanks are going to be empty. And now there's nowhere to get the oil from. So now Saudi Arabia may have actually, pulled off an actual coup in the oil market here because he is going to put a couple of shale players out of business down here. And in my opinion, I think the price is likely to only work its way higher over the next several months and weeks.
Yeah, it's interesting you mentioned ESG. One of the factors not measured by their ESG rankings is antitrust and monopoly issues, which is something that you and I have both written about and watched. The top holdings in these ESG funds are, Apple, Amazon, Microsoft, and, news came out recently about Amazon and how they're treating their employees through the coronavirus. You could agree with it or not. It could impact your willingness to buy from them or not. But one thing it did not budge is their ESG ranking because, ESG has turned into something where it's like, hey, we're going to give you Virtu without any tracking error. We're going to make sure that you're going to track the markets. You're going to have your FANG exposure that's driving the markets, but you could check a box and call it ESG.
Isn't it amazing, Phil, how the narrative worked both ways for big tech on this one?
It is unbelievable. It is unbelievable.
It's frightening. It's frightening to me. We were, and literally, not to mention, just while we're on the topic, we were lightly having that conversation, or at least it was a back burner item, it seemed, for President Trump to go ahead and address it. He mentioned Jeff Bezos more than once and directly. And I think that he was telegraphing potentially that, he's got an antitrust situation that's bold as daylight, happening here in America. And I think that he might have addressed it, or at least I think the public climate might have been in such condition that we were willing to address it. And now it seems like, we get hit by the coronavirus. Amazon is the only place to do business. The stock goes straight up while the world goes down. Bill Gates emerges as the overlord of the human health crisis out of the blue. And, all of a sudden tech's back in the driver's seat.
Yeah, it's devastating. I'm in Michigan, and small businesses were forced to close down. In no time, the chain restaurants had all sorts of processes to order online, to go to drive through, to pick up. And you walk through or you check on some of the restaurants that you love, that you want to see, and you see these like handwritten signs in the window. My dry cleaners has a note: hey, if we have any of your items here, call my cell phone to pick them up. We're not going to open again. People have been just completely wiped out. And you're right, the only places you've been allowed to do business is at those same big tech companies. So, the gap, and I want to talk about this when we get to equities, but the domination of the FANG names within the equity markets and the gap between the wealth gap and the business wealth gap is just been so exacerbated by this, and it's really devastating. And it's like a rubber band. At some point it'll snap, and I think we're nearing that point. Just picking up sentiment from the man in the street, people have had enough.
I totally
Before
agree.
we get off of oil, though, I just want to talk about one more thing, which is USO, the oil ETF, by far the largest oil ETF, which for years has without major issue, it's held the front month contract, and as that contract nears expiration, it rolls back to the next contract. And in a situation that you described, in a situation of contango, where the later months are trading at a more expensive trade at a more expensive price, that roll costs investors money every month. It's a little bit of a drag on the performance. Well, I mean, that kind of hit an extreme. And what we saw, of course, was retail investors. You can look at the Robinhood ownership. Over 200,000 new investors came into USO as the price collapsed, thinking they were going to get a great deal. And they just got decimated by the USO contango trade. How did that work exactly?
Sure, Phil. Well, you have it spot right where the USO equity ETF has to have futures contract exposure in WTI crude oil, since that's the commodity that it's trying to track. What happens, as you say, with the contango roll is you're paying up to roll into your next month. And obviously there's no rollover in the USO ETF. So that loss, which you pay up to roll out, gets factored into the price, right? And a little bit of a percentage of the price comes off the top every time they roll. Well, what happened with this May episode was that they had a small portion of contracts left in May, but I think largely had rolled out of them, at least by the time it went negative, or they may have had some residual. But what they did was, because everybody foresaw this in the oil market, they said, we're going to skip June because this is likely to happen again in June, which was absolutely the truth. So if USO and all the other commodity indexers would have just rolled directly from May into June, we would probably be watching the June contract, drown at 10 or 12 or $7 on its way out. But we're not, because everybody jumped over June. So now there's no length in June, and there's only length in July and August. So you have to consider one thing, though, that's really important. When they roll to those higher months, not only are they paying a higher price, but they're paying a much wider spread to get out there. So in addition to the cost of rolling up in price out the curve, they're paying a wider transaction cost that nobody has built into their model either, because now they're going from paying a 1 penny spread in front month WTI futures to potentially paying the bid offer of a 50-cent spread in the futures that roll out to July and roll out to August, or 20 cents. So now they're paying an exorbitant amount on top of the cost. They've got a huge roll cost. And that's where all of that cost has to get figured into the ETF and basically leave the holders holding the bag. And that's why the price got diminished even more than the price of crude oil. And even more directly, on the way up, it's not going to follow because it doesn't have length in the front month, which is now going up faster than the back months because there's no length in it. So when somebody comes to buy a June contract now, there's nobody to buy it from. There's no overhang. There's no overhang of merchant length. There's no overhang of indexing length. And May has just been floating away like a butterfly. So it's an interesting dynamic. Now, we had last week or 2 weeks ago, I meant June, but we had the dynamic, I think it was last week, where June started the week off with a 10% rally. I think it was on Tuesday. And so that's a 6 sigma rally in oil futures. What that does to the risk behavior of the market? That's an animal spirits igniter. So just by the law of small numbers, crude oil bouncing out of this hole of large magnitude. And again, with the potential for there not to be much oil on the way out on the flip side, after we shut in all these wells and close off all the rigs, we've got a really, really sticky situation building up in energy right now.
So what is the best way for a retail investor, someone that can't access the futures directly? What is the best way for them to trade oil if they were bullish?
My honest answer is you can't. My honest answer is that crude oil is a commodity contract, is a futures commodity, right? It's built perfectly for futures. And the equity is just a bastardization of that. So you have to understand that you're trading the bastard item going into trying to trade USO. And the reality is that it is a futures contract meant to be traded as a futures contract. Now, you can still express length in the energy area. I haven't found a useful direct oil ETF that I trust, but I've been recommending to my clients that I think it's probably maybe better risk reward. Not necessarily better risk reward, but at least as safe a liquidity play is to just trade the majors. Right. I just feel like right now, like I can't find an oil ETF that works. I'm capable of trading futures. So I do that if I have a view on the commodity, but I'm actually trying to shop for some of these majors that I think can really, really bounce once we come around and the demand picks up. And then we turn around and look back and see that supply has been diminished and the wells are capped off. So that's a way out in the future scenario, but it's definitely one that I see developing. Like I said, I'm just going to be honest with you, Phil. I don't think that there is a good equity ETF to express risk in the commodity of WTI crude oil.
Yep. Let's talk about the equity markets. There's been a feeling out there, and this is something that you've observed, I have as well, that there's a disconnect between stocks and the economy, obviously stocks and the intrinsic value of the stocks themselves or any sort of fundamental, that the markets are broken. There's the trade. If you say that the markets are broken, they're untethered from reality, they're just going to float based on the Fed and narratives, then you want to be long equity. And you've made that case, and I've made that case. And you get a lot of skepticism about that. People are like, oh yeah, everyone's complaining the Fed is just driving everything and the markets are broken, yet they've been wrong because they're all perma bears and long gold, but the market's been going up. And that's completely, not the case at all. Where do you stand in that debate?
I keep the two conversations separate, Phil. If somebody wants to talk to me about the economy, I'm happy to have that conversation. Somebody wants to talk about making money, that's a different conversation, right? So the market conversation is not the economy conversation. The market conversation is, like you said, a Federal Reserve conversation, because obviously shutting the global economy to zero is going to cause devastation across the economic front. However, because we have a largely financialized economy, the Federal Reserve can do these, and we can call them perform a market distortion and make liquidity available at an unprecedented pace in history. Now, the reason why this liquidity coming available in unprecedented form is having such an unbelievable effect and creating what I'm calling financial postmodernism, where we get 8 million unemployment claims in a day and the S&P goes up 15%, in the next 2 days, like where everybody in the world, including me, is like, well, that's weird. This is financial postmodernism. And this exists because the Federal Reserve is pumping liquidity into the situation where all of the sellers have already blown their brains out. Like that, to me, is the most important part of the dynamic. People were not studying the sell-off as much as they were in awe of the sell-off and being shocked by the sell-off. But if you study the sell-off and you really dig into the period, and I think I nailed the date down from Feb 26th straight through to the bottom to May 20th, within that month, we had 10 days of extreme tick index prints, which illustrate extreme selling, where everything in the S&P is just hitting the bid, right? So we had 10 out of 14 days that we saw extreme tick index prints of over minus 1,500. That in itself is historically unprecedented. That tells the story of funds, one or more, blowing up and hitting bids in liquidation, right? That happened because obviously they get caught wrong-sided. Their volatility position is all wrong. The lower prices go, the more stock they have to sell. And you run into that waterfall bottom that we finally came to in the S&P at around 2,200, right? Optics matched the S&P at that date back in March, because that's when we were talking about the shutdown and nobody knew what it was going to mean. So the market took it to the extreme and said, oh, what it means is S&P 2000 and lower, until the Federal Reserve showed up and said, well, we can actually alter that plan with all this liquidity, all these emergency mechanisms, all of the funny money going out to Main Street in the PPP and the SBA loans. And we can sort of fix the optics so that people will stop selling stocks. And I feel like that's what happens. So if you want to get into the stock conversation and talk about the rotation that to me really revealed itself, we went to a rotation first where the restart was going to be later than we thought in terms of the equity sectors that were moving. And then we went into an equity rotation that was very much telegraphing reopening the economy. And the equity market was reflecting that. So it doesn't matter sort of what price you start from. Once the equity market starts digesting the information and the Fed liquidity and the money starts flowing into the sectors that it wants to flow into, you can't hide any of that at 40 vol. When volatility is going this fast, man, portfolio managers get positions in the door and then their footprints are all over the tape the day it's over. And so you can see where the money's going and you can say, okay, so they're pricing in an earlier than expected restart in home builders. Right. And I know that many people are going to be on the unemployment line, et cetera, but that was a really strong sector of the economy before the crash. And so my guess is that the market is looking forward and saying, well, with lower interest rates, we've still got people that want to buy homes. We've got very little inventory. So that's probably a good scenario for home builders. And, then that's just one sector. But, then you see one sector like that get going. You see big tech never really had a significant scary dip. And now that they're coming to the rescue of a lot of this crisis, we're going to see those stocks rally. And like I said, that's the money making or market conversation. If you want to go into the data where we've got millions and millions of people unemployed and that are going to be looking for jobs and how much our economy is going to change because of that, that's another conversation, but it's not the one about making money.
Right. And I mean, millions, it's more than that. It's 33 million and at least 33 million and counting. Right now it's May 11th. I mean, who knows where we're going to end up. And yeah, a lot of those losses are temporary, but not all of them. We are going to struggle to get those jobs back, at least to get them back to anything sembling. I mean, 33 million, it's just a number. It's a theoretical number if you don't deal with these numbers every day. And to put it in perspective, it is, where did we top out in global financial crisis over a period like that, over a 5-6 weeks period? Couldn't have been more than 6 or 7 million.
Yep.
So it's orders of magnitude more. And you look at the runaway in the stock market and the runaway in the FANG valuation. The FANGs are now more than 20% of the S&P 500. You look at some of these companies like Shopify is now trading at a market cap 2 times greater than the entire U.S. airlines. You take Delta, American, United, you put them all together. Shopify is worth twice what the entire airline sector is. And yeah, there might be some bankruptcies in the airline sector, but the whole thing is not going under. People still need to get to visit their aunt in Seattle or, whatever it's going to be next year. People are still going to be flying. The PE on Zoom. So Zoom, we're actually speaking on Zoom right now. Zoom's a great company. It's a great story. The PE is about 1,800 and the PE on Delta is 4. I mean, if there's, liquidity and this thing is just going to keep running, like what's the difference what intrinsic value is? What's the difference? And you've seen these value managers banging their head against the wall saying, this isn't right. This stock, I've done my research. I've looked at the breakup value and the this and the that. This stock, the intrinsic value is worth, so much more than where it's trading. The money has to come in and true up. There's been no true up. And I don't see any true up on the horizon because the stock market has just become a parlor game completely separate from, like you said, separate from the economy, but also, I believe, increasingly separate from the stocks that they represent.
Totally. Well, you sort of, you hit it right on the head. It's like, we're standing here on this side of coronavirus saying, where is the demand going to come from going forward, with all this economic damage, 33 million people unemployed and the consumer who has been such a driver of the stock market is now damaged. And how does it continue? And I wrestle with the same exact question. And that's why I tune into the Federal Reserve when Jerome Powell has prepared remarks after their last FOMC meeting. And he says that the Fed is going to use the emergency lending powers forcefully, proactively, and aggressively until they're confident that we're on this recovery path. So there's the answer. That's where it's going to come from. It's going to come from the balance sheet. And the balance sheet broke through, resistance at 4.2 trillion, and it just kept going. And now we're at like 6.6 trillion. And I think that that's a sort of Rubicon River event, and we've crossed it. And I don't think that there's a limit anymore on the Fed balance sheet. Because like you say, these airlines are going to have to keep operating. They just don't have operating capital right now because there are no passengers. Okay, where are they going to get that from? Federal Reserve is going to be there. And then it's going to be, whichever company is next, it's going to be where are they going to get it from? Well, the Federal Reserve is going to keep pumping money into this market. And while it may not be a truer earnings multiple, it may be a bigger multiple. and it may be because of a weaker dollar, and it may be because of weaker global currencies. And, all of this is stuff to be factored into the, investment landscape, because clearly we don't all want to be in all stocks at any point in time now. So I think it's never been more important to be diversified.
Yeah. Yeah. I mean, weaker dollar obviously seems to be the long-term inevitability here. People are talking about possibly stagflation or deflation in the short term, but I think in a long enough term, you talk about those numbers, $6 trillion. People don't think about how much that is per citizen. That is, that's more money than people can pay off. So, or at least that they can pay off without inflation. One of the interesting trades that you've been talking about is being long jets, which is the airline ETF, which is, along the airline industry. And this has been extremely interesting because Warren Buffett, famously was, I think like a 9-10% owner in Delta and American, I think two of the airlines. And he had done some selling in them. And there was a lot of speculation. Well, he's getting under the 10% threshold, so he doesn't have to report what he's doing. And then he can announce taking a massive stake under the radar. But that didn't happen. He went the other way. He went and liquidated in his meeting just last week. He announced that they've liquidated their airline positions entirely. Does that scare you out of the trade?
Well, it doesn't scare me, but it makes me think. It has to make me think, because I'm not a follower of Buffett. I feel like his era is sort of coming to an end. I feel like that last conference call was sort of sadly reflected that a little bit. But at the same time, he's one of the great investing minds of all time. So if he's getting rid of them, I want to look and see through sort of what the market said and realize why he's doing that, right? So it's these kind of, the airline trade is, for me, it's losing its luster, quite honestly. Like, I've got it a little bit on an egg timer now, especially since Buffett is out of the picture, because it's one of those sectors that I thought was going to be turnkey back on to, maybe not 100% capacity of what it was, but turnkey back on to 75%. And the more I think about it now, the more, the more people are going to be afraid of flying, and the more airlines are going to have to adjust to the new biosecurity measures. That makes flying a much different proposition. And now sort of, I'm thinking about it in ways that I hadn't thought about it before. And I'm saying to myself, well, people are going to want to get back to traveling, but not at an insanely exorbitant cost or an uncomfortable predicament. So if it becomes the kind of thing where, flying to Miami is no longer a $250 item, but it's a $500 item, and I have to submit to, a telehealth checkup the night before and the morning of, and then I have to be at the gate 4 hours earlier, guess what? I'm done flying. So I'm trying to think of these longer term effects that could happen. And that sort of scares me out of the airline trade. I usually don't balk just because I see a big hold or sell, because a lot of times that's just removing a big weight of overhang off of the tape. But they're really, in response, the airline ETF jets hasn't bounced much. It's the kind of thing where I would probably keep raising my stop from below the market until it finally either met the market and took me out, or the airline sector rallied and I kept trailing, staying behind it. But I'm not as in love as I was buying jets on the sort of lows that I bought them on, to be totally honest with you.
What do you like? Anything else kind of open, dealer's
Yes.
choice? What do you like going forward that we haven't discussed yet?
Yeah, okay, that we haven't discussed yet, because we've touched on big tech, which I'm getting, I'm coming around to being bullish, because they're in a much stronger position on this side of the coronavirus. So, going down my list of things that I love, it's definitely energy and big tech up at the top, and sort of home builders right behind that. I'm kind of staying away from the heavy industrial stuff now, because I fear that there may be another shelter in place order that sort of maybe just as a shock or a scare, but I feel like the government is going to want to tamper with that to keep the people as controlled, and to sort of do experimental controlling to see if they can come out after reopening the economy and say, well, we got some coronavirus springing up over here. We're going to have to shut down this portion of the economy. And then, next thing you know, part of your supply chain just got destroyed and your stock's down 20%. So I'm trying to avoid that kind of thing, but I keep coming back to home builders after tech and energy. It seems like that's a sector where they're sort of, we've had some deleveraged home builders underneath. There's smaller inventories than there've ever been in existing homes. And now I feel like we're going to have people moving out of the city at all costs to the suburb just to get a little space. So I feel like that's a really good opportunity there. And I'll be honest with you, Phil, I try not to spread myself too thin, especially when I'm playing a couple of bullish opportunities like I think that we've got here. Because the best thing about 30 and 40 vol and the transparency of it all is that it gives you a chance to upsize your bets. And I'd much rather be sitting here staring really, really intently at big tech and builders and energy stocks and not miss a 5-bagger there. Then try to, say, well, do I like healthcare? Do I like transports? Do I like retail? I don't know. None of them really excite me. If these 3 sectors excite me, I'm looking for a chance to put like 5x my normal bet on the table because I feel like I've got a beat on them and they're going the right way. So I'm kind of concentrated.
It makes sense. And seeing things move now, I mean, this is, if you don't enjoy trading, even if you're talking about your personal account, even if you're talking about just a couple $100 to play with, if you don't enjoy this, then, you're in the wrong industry because
I mean, I'm laughing when I'm getting stopped out. I'm saying, well, that was fair.
Yeah, that's right. Yeah.
It usually takes 2 months. It took 2 hours, but you know what? That was fair.
Yeah. That was all of February and March where literally you get a year's P&L in a day. The market's moving, 5-6% a clip. It's crazy.
Yeah, it was fantastic.
Tony, I like to close with this question. Tell me about an obstacle that you've had either in your personal life or your career that you've either found a way to work around or persisted through.
I tell you, I may as well associate this with a topic that we've discussed. And as a trader, I will say that, that this financial postmodernism used to be something that would get me. And rallies off of the lows used to be something that would get me. And I have since pivoted my thinking to not needing the markets to agree with my view of the world. And it took me a long time to be able to do that. You educate yourself as best you can. You read the Journal and the Financial Times every day. You went to a good college and you feel like you've got a good brain between your ears. And all of a sudden you start thinking that the world should look in a certain way. And when you think that and start placing bets in the casino on the markets accordingly, you realize that your vision of the world has got nothing to do with the tape's vision of the world. And then if you say, I learned that lesson because I paid for it, Phil. I learned that lesson by losing money, being short out of crisis situations, looking for, follow through. And I'll be the first one to tell you, I made a fortune in the financial crisis on the way down. I just forgot to get bullish. So it's like it's one of those, that was the most valuable experience. And luckily I'm here to live to tell about it because it was something that was just sort of eye opener. And I knew that if I got it right, I would be able to make back the money that I lost with no problem because there would be the volatility that presented itself. And, you can be sure that I was salivating when the S&P started crashing through 2,500 and we were talking about shutting the world in, et cetera, et cetera. And now it's just like, okay, where's the Federal Reserve? Because as soon as I see them open their mouth, I'm going to come in buying everything like David Tepper did in 2008. And this stuff actually works, because the financial markets aren't built to collapse in a day. While there may be an awesome trade from the short side building right now, I'm still reading the market indicators on a daily basis, and they're still telling me that the markets can go higher. So I'm not going to fight that until they start telling me that they can go down and demonstrably again. So that's kind of the lesson I think that as a trader I've learned, and it's coming in so handy now that, had I not learned it, I might have been bankrupt on this sell-off for now. But I paid for the lesson and I learned to have a more optimistic attitude about America and more faith in our ingenuity in times of crisis. And next thing you know, it pays off in spades. So I guess that's the most valuable lesson I've ever learned in trading.
And more optimism for the ability of the Fed to just prop the whole thing up.
It's not as much optimism that they can save things. It's just knowing that that's how the game is being played. It's just like in a poker game, when somebody turns over a card and it causes you to fold, it's just like, well, my odds were, that's what the odds told me to do. And picking this up is just that skill saying, well, the odds now at 2,200 are that the Federal Reserve doesn't let Jamie Dimon and Goldman Sachs go bankrupt from here, right? That's likely to happen. So I've got to start thinking differently. So that's all.
And it goes back to what you said earlier about, hey, do you want to know about the economy or do you want to know about making money?
Yeah. Two separate conversations, man. And they're both intense right now.
That's it. That's perfect. All right. Well, thank you for coming on. We'll leave it there. Tony, where can people sign up for the newsletter and learn more about your research?
Yeah, my whole background is on tgmacro.com. There's a page there that tells about my background and a page where you can read about the products that I offer in my publication business. I write a daily newsletter called the Morning Navigator. I have a more advanced package called the Point Lookout package that includes some extra reports every month. And my clients are very happy. I can supply testimonials at any point. And that's it. We're in a really sweet spot for traders right now. So I'm trying to focus as much attention as I have on the markets, Phil.
All right, sounds good. Thank you for coming on, and thank you to the audience for listening. We'll be back on next week.
Thanks for having me, man.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.